Okay, so in this video, we're doing a 50 mark exam type paper question on ratios, right? So typically, it'll give you a good way of answering questions in the exam because, like, it's actually quite good to see a financial statements all year because we need to know what we're working with. Okay, so first let's go to question one. Now, firstly, before we go for question one, you have to take note of additional information over here because over here when you want, for example, only credit sales, you can't just take the sales figure. You have to use this information to get only credit sales or whatever you want, right? So the first question asks, right? Also take note which years they're referring to. What is the percentage change in sales in 2023 and 2024? Okay. Percentage change in sales is very, very easy, right? What is the percentage change from 2023 and 2024? You work out the difference over the previous one times 100, right? So as you could see over here, that's what they did, right? They got the difference by minusing both over the previous year times 100, 31.6%, right? That's a calculation for percentage change, right? You always do that. Second question, calculate the gross profit percentage. Now, gross profit percentage is your gross profit over sales times 100. If you look at this over here, your statement of comprehensive income, there's no way stating what's gross profit. But gross profit is sales minus cost of sales. So if you work with, for example, 2024, to work out gross profit, right, as 2.1, you first have to get gross profit in the numerator on top. So gross profit is sales minus cost of sales. So just say sales minus cost of sales. So that will be gross profit over your sales, which is 1,290,000 times 100, and you get 33.8%. Similarly, you do it for 2023, same thing, and you get 40%. Now, gross profit, what is? Let's interpret it, right? So we can clearly see in the beginning of the year 2023, we had 40%. At the end of the year, right, 33.8%. So it dropped, right? So gross profit, right? Gross profit, it's very, very, very important. So gross profit percentage basically says like how much of profit are you making on sales, right? So for in this case 33.8%, it means 33.8% of the sales is your profit, gross profit basically, right? Now obviously the higher the better because you're making more profit. So 2.2 goes to say, has the gross profit changed? So obviously yes, the change, right? Provide two reasons for the gross profit changing. So anytime you're answering these questions, you must ask yourself what's the calculation for gross profit percentage. Say it's a gross profit over sales times 100. So how does the fraction get big over there? It'll be either when the numerator on top gets big or the denominator gets smaller. But we'll basically look at the numerator on top getting big. So gross profit. So the more gross profit there is, obviously the percentage will be higher. So you already think about it. Gross profit is sales minus cost of sales. If your cost of sales is too large, that means your gross profit is going to be small. So you have to reduce the cost of sales. Huh? Now, if I had to answer this question, I would say there may be a lot of people stealing stock from your business because that will add to your cost of sales. There might be a lot of obsolete stock, but basically there's like less sales. So if you can see clearly, let's say there's less sales and there may be increased cost of goods are sold, right? So that makes more sense because when like goods are stolen and all, it increases the cost of sales. So when it's too little sales or when cost of sales is too much, the gross profit is very less. So yeah, that's maybe the reasons for that. Now 2.3 asks to interpret it, right? So okay. So if we have to interpret this, right? 2.1, let's say 33.8%. How do we interpret it? So if you really look at it, what is 33.8%? That is 33.8 over 100. Now if we just simplify the denominator to 1, so you divide both sides by 100, you get 0.338 over 1. So gross profit is basically 33.8 cents over 1, so over 1 rand. So you can just think about it logically, right? This will always be like in sense. So for every 33.8% of like your gross, not gross profit, yeah, gross profit. Okay, so basically 1 rand is a full sales, right? Based on that 1 rand, you're getting a gross profit of 33.8%. That's what it actually is, huh? So yeah, you can also say the business spends 64.2 cents of cost of sales. But basically, the main thing over here is 1 rand is your sales and 33.8% is your gross profit. So you have 33.8% for every rand in profit to cover all other expenses. So 3.1, what is the net profit percentage? Net profit percentage is your net profit over sales times 100. Net profit is your final figure, right? Net profit. So, for example, this over here, your net profit will be the final profit after tax, obviously, over sales. So that's how they got over here 204750 over 1,290,000 times 100. 15.9%. Similarly, you do the exact same, this over this times 100. 3.8%. Now your net profit percentage change will tell you how much of net profit you're making on your sales. So again, if I had to interpret this, for every 1 rand worth of sales, you're making a net profit of 15.9 cents. So yeah. Okay, so let's go to 3.1. Okay, we already did that. Okay, 3.2 has a net profit changed. Yeah, it went more up. So that's good. So the business have been more effective in controlling operating expense to improve the gross margin. So to calculate gross profit, calculate a gross profit percentage, obviously your net profit over sales, right? Sorry, your net profit margin is your net profit over sales. Your net profit is your profit for the year. So obviously if you decrease your expenses, that means you're very good. Your profit will be higher. So that's what they're saying over here, right? More effective in controlling your expenses. Reduce expenses. 3.3. Same thing I just said, right? For every 1 rand worth of sales, the business has got a net profit or retained 15.9 cents. That's how you comment. So 4. Okay, this is very, very important, extremely important. 4.1. How do you calculate days inventory on hand? Days inventory on hand. Now I'll give you a tip. Whenever you see period or hand, it's times 365. Days inventory on hand is your inventory over cost of sales times 365. So inventory over cost of sales for the year 2024. So inventory is 200,000 over cost of sales 853,500 times 365. Times 365, you can put it there or there, and it doesn't make a difference. That's a fraction. Now, when you get a number, you're gonna get like 87.677 or a decimal. You always round up. So if you get 86, if you get, for example, 85.6, you won't say 85.6, you'll say 86. If, let's say, you get 85.4, you will say 85.4. I'm just thinking, do you round up or down? Days inventory on hand. Round up. Yeah, always round up. You know why? Inventory on hand. Inventory, you can't say 0.2 inventory. You have to have another whole inventory, so round up. Yeah, so 4.2, what they want now? Creditors payment period. Formula is your trade payables over your credit purchases times 365. Trade payables, we got you very, very easy. 214,750. There we go. How do you get purchases? Okay. So obviously over here they don't give you purchases, so you have to really think about it. You all know the formula. Opening stock plus purchases minus closing stock is equals to cost of sales. So solve for purchases. So put all the equations to the right if you think about it, huh? So if you take your opening stock plus your balance at the beginning of inventory, balance at the end, minus balance at the beginning will give you your purchases. It's the same formula. opening stock plus purchases minus closing stock is equal to cost of sales. I'm just manipulating the formula to get purchases when I have everything else. So solving for x basically. So I just put that over there, times 365, and it gives me 88 days. Now for 4.3, what they want debtors collection period. So this is trade receivables over your credit sales times 365. Trade receivables is 193,800 over your credit sales. So I know my sales here. Just that I need to get credit sales. They tell me over here 75% is on credit. So I'll just say 1,290,000 times 75%. That'll give me my credit sales from there. And times 365. Done. Yeah. Now the purchases, when we had the purchases final figure, everything was on credit. So that was just our purchases on credit. Very, very, very important. Working capital cycle for 2024. Formula for working capital cycle is your days inventory on hand plus your debtors collection period minus your creditors collection period. So in 4.1, we worked it out here. 4.1, what we worked out, yeah. Days inventory on hand. So we take 86 days plus 73 days. This was your what it was, your debtors collection minus your creditors payment period. So minus 88, 71 days. So it's your days inventory on hand plus debtors collection period minus your creditors payment period. So the lower the better, obviously. Basically it means how long it takes you to get like your cash, working capital cycle. So 6.1, what do you understand by days inventory on hand? It's the average number of days it takes for inventory to get sold in a business. For example, if it was 50 days, it takes 50 days on average for inventory to go out from the shop to get sold. Obviously, the lower the better. Creditors payment period. On average, how long it takes the business to pay the creditors, huh? So you owe people money, how long it takes you to pay them. The higher the better, because when you don't pay, when the creditors tell you that you can only pay them longer, that's good for you. You can make more money because you can borrow without paying back very, very soon. Debtors collection period 6.3. Number of average days debtors to collect to pay in the business. The lower the better, more cash is coming in. Otherwise, my debtors are not paying, that's bad. Taking too long, that's bad. 7.1, calculate the total asset turnover. Total asset turnover. Turnover is sales. So what you must think of is sales over your total assets. So sales over total assets. Turnover. Turnover, there is no times 100. All turnovers, there is no times 100. Right? So to do that, it's very simple. Total asset turnover is sales over total assets. So sales is 1,290,000 times total assets. They don't give you total assets over here, but you have to work it out. So add your non-current asset plus your trade receivables, that's an asset, plus your inventory, that's an asset. And yeah, that gives you that amount. And yeah, you should get 0.82 as your answer. You don't have to show point like that one thing. You can just say it's equal to 0.82. And yeah, what it means basically, whatever is on top is a 1 rand. So for every 1 rand invested in the assets which you have there, the business is able to generate 82 cents in sales. Yeah, because what was our total? Wait, what's our formula for total assets? Total sales over your assets. Oh wait, total sales. I see what happening here. So normally this figure will be high, but this figure now is low. Okay, so if we actually work out this amount, right, you're gonna get a very high figure. So this will be higher than your actual sales. So in this case, your assets are higher. So you'll see for every 1 rand invested in the assets, the business is able to generate 82 cents in sales. Yeah, basically. So for the other one, it's the same for the other year, exact same, literally. So 8.1. What? Briefly explain. Oh, wait, where we are. Okay, what 7.2, what asset turnover represents? Total asset turnover is basically total asset turnover, sales over total assets. Okay, it's also how much the sales is covering of the assets. Here, this comment here you can say in your own words. Total sales over your assets. So how much is the sales is covering of the assets, right? Yeah, that's also another way to say it. Yeah, asset test ratio 8.1. Okay. To calculate asset test ratio is your current assets minus inventory over your current liability. Yeah, asset test ratio. So let's work with our current assets here. This is non-current. So current asset will be trade receivables. It will be your inventory. Trade receivables, inventory, and it'll be your 44,000. Yeah, current assets. Over your current liabilities. I'm just seeing where's my current liabilities. Yeah, I've got my long-term debt. Where's my current liabilities? Oh, trade payables is your current liability. 214,750, and yeah, that should give you an answer of equal to 2.04. So basically, your current assets minus inventory, that's like 2.4 times your liabilities or current liabilities. Yeah. So is this good? Yeah, very good. The higher the better. It means you're covering it like two times. Your asset is two times more than your liabilities or current liabilities. Um, 8 point. Explain the difference in current ratio and asset test ratio. Current ratio, the formula is current assets over current liabilities. Asset test is current assets minus inventory over current liabilities. So asset test, you're removing inventory. So the reason why they remove inventory is because inventory is very hard to convert to cash sometimes. So it's good to remove it to see how liquid the business is, how quickly the business can do without inventory. Yeah, excludes inventory. Yeah. 8.3. What type of companies would use asset test ratio? Companies with inventory balance. Okay, so basically companies that have a lot of inventory, work with a lot of inventory, right? Shops, for example, they would want to do the asset test ratio. 9 point. What 8.4? What are the ratios attempting to measure? The cost of business right now. Yeah, so basically, you're trying to find out, right, if you can get the money from those assets to pay off those liabilities in the short term for current ratio. Yeah. So basically, yeah, that's what it is. So to basically convert those assets into money so you can pay off those debts, those liabilities. Briefly explain gearing. Okay. Gearing, 9.1 gearing. Whenever you think of gearing, think of debt. So gearing means the debt to the level of okay. So gearing is basically like your like your debt ratio. So it basically says how much of debt you got in the business and how risky you are. High gearing is bad, low gearing is good. Financial risk, uncertainty, right? So will the potential return be higher than the cost? So this is uncertainty. For example, you're taking a high loan interest. That's bad, right? Uncertainty, you won't be able to pay it. Capital structure is a debt equity ratio in the business. I don't know. I never know that, but you don't need to know it. Didn't come out. This is a past paper from back in the day. So yeah, capital structure. But it makes sense. Capital structure is how you get capital in the. Oh, okay, right. Capital structure basically means how you get capital in the business. So the best way to see it is your debt equity ratio, which tells you is your capital more debt, is your capital more equity. So yeah. So that's the 50 marks of this ratio and analysis video.